What's up, YouTube? Welcome back to the best YouTube channel out there. I wanted to do a video on how to trade options. I think options are pretty cool. I've been trading options for a couple of years now, and I found some success. I found some failures, and I wanted to talk about today what are options and how you can get started. This is a 1,000,000 view on how options work because I don't want to do a 10-hour video on every little nuance of options. And I would probably have to do 16 10-hour videos because it's quite a complex topic and a financial instrument. But I think they're pretty cool. And if you get to understand what options are and you play them the right way, I think you can make a lot of money in the stock market. And I'm a fan of the stock market because it doesn't take much money to get into. Unlike real estate, you have to buy a house and get a mortgage and all that cool stuff. And it takes a lot of cash, just being honest. So whenever you're playing options, whenever you're trading stocks, you don't need much. And that's how I got started whenever I was just a teenager. And I've learned so much over the years. But I wanted to do a brief overview and an intro course into how options work. And hopefully we can do it under 15 minutes. Okay, so bear with me. Introduction. What are options? Options are contracts that give you the right to buy or sell a stock at a certain price by a certain date. And a lot of this will start making more sense as we use some examples. But we have two types of options. We have a call and a put. A call, you're betting the stock will go up. A put, you're betting that the stock will go down. So this is an options tree for Google in the call side. If you have Robinhood, you can go and, click around. This will look pretty familiar. I like the trading in Robinhood because of their UX. And I know they can be a little controversial, but the app's so easy to use. So that's why I've been using Robinhood for the past couple of years. But this is an options tree. Like I mentioned, on the call side, we are under the buy call. What is it called? Builder, whatever. As you can see, this is the price of the underlying today. So we're trading on 193. And as we get out of the money, our contracts are worth less. If we get in the money, our contracts are worth more. Why is that? So when you're betting that your contract, when you're buying this call, let's say you're buying this 200 call and you have to put up $67. Okay, so you're betting that Google, by the time this expires in 6 days, which is August 1st, the underlying, which is Google, would be trading at $200. And as you can see, your contract would be worth significantly more money because you'd be down here. You'd be somewhere in the house of $600, $700, and you've essentially done a 10x from your initial investment. So there's a lot of leverage. There's a lot that goes into it, but this is how you'll look if you go into the options tree. Don't be intimidated. I know there's a lot of numbers going on, but the important ones are strike price, your break-even price, which is essentially the price, the strike price plus your premium. Pretty straightforward. Percent to break even, how much does the underlying has to rise so you could be a break even, and then change, whatever that means, doesn't matter. And getting a little bit more nuance into how these contracts work and some of the numbers under them. So we talked about the strike price, we talked about the expiry date, and the premium. So with this contract, this is a call to buy Google at the strike price of $197.50, and it will expire on the 8th. And for that contract, I'm putting up $236. Let's say you got into this trade at a midpoint right here. And with that, you then have a contract that gives you the right to buy Google at 197 if it's in the money or out of the money. We'll see. So this is essentially how a call works, and a few different terms over here at the bottom. The Greeks, they're super important, but the most important ones are delta and theta. So delta is essentially how much the option moves with a $1 move in the price of the underlying. So if Google were to go up $1, if you were to go up to 194, my contract would then get affected by $35. So as you can see, I basically made 35 bucks if Google goes up $1. So you can start calculating how much money you're going to make if Google reaches whatever strike price that you set by set date. So we're betting that stock's going to go up and we're going to get rewarded by it. So in this case, we are making 35 bucks every time Google's up by $1. So theta is very important too. How much value the option loses per day or time decay. So every day that the stock market's open, that this contract is still valid, we're losing $15.29. So this is the bad thing with calls, time decay, theta. It starts ramping up here by expiry. So you best bet that Google is trading at $200 by expiry date so you can make your money. Okay. So that's the thing with calls. Whenever you buy calls, you're kind of putting up a lot of hope and prayers that your underlying will go up to your strike and even past your strike. So you're probably wondering, why is this thing in the red whenever I hit my strike? So this is a chart over here with the price of your the price of the underlying here on the left. These are the dates up top, and this is the percentage change of Google, the underlying, according to the dates. So this is how many dollars you're going to make per day according to the price of the underlying. I think you guys understand a little bit, but this is how much we got into trade, 236 bucks, and we are going to lose all of our money by the 8th if this thing is not at 197.5, because our contract will be worthless. We can't assign. We don't have anything in our hands if we get to the 8th and Google is under 197. So that's the price you kind of have to pay with options and calls more specifically. So a few different things with premium that are very important to understand. We talked about theta and time value. We talked about intrinsic value and how much it matters for you to be in money, right? So this is the real value of the option. And whenever you're in the money, if you're out of the money, like we saw up there, you have zero intrinsic value and your whole contract's based on extrinsic value. And we'll get into it in a little bit. But for call options, how do you calculate intrinsic value? You do the stock price minus your strike price. So let's go back here. We have our stock minus our strike. So for this case, you be 0 dot whatever. That would be the price of our intrinsic value. We have an example here at the bottom as well. 105 as the price of the underlying. Strike price 100. The premium for the contract would be $7. How do we calculate intrinsic value? That's it right here. Stock minus strike, $5. And then the other side of the coin. What else in this contract? I'm seeing so many numbers. My contract's at the money at expiry, but I'm losing. Why am I losing? Because of extrinsic value. So on that same contract, we have that stock price of 105. Our strike is at 100. Our options premium is at $7, right? All things are constant. We then calculated that our intrinsic value is $5. So what else is there? It's our extrinsic value is $2. So this is based on time decay. And this is essentially how much the contract's worth given the time value. Okay. So yeah, right here, based on how much time is left until expiration, higher vol equals more expensive premiums, and more time left, you have higher premiums regarding extrinsic value, because there's more time for the stock to rise up and for the contract to be in the money and be worth more money. That's why extrinsic value is higher for longer longer strikes. Okay, so now that we understand a little bit about how calls work, I think it's important to mention as well. Here are some of the risks. You can lose 100% of your premium if your prediction is wrong. If your contract goes to expiry and it's not in the money, your contract will go worthless. You just go into the void. You're going to lose your $236, and that's your fault because you didn't do your due diligence or you just lost in the trade, which will happen. And like I mentioned, they expire. They're not like stocks you can just hold. This is a thing that expires and goes to the void, and you literally have nothing to hold. And we'll get into a little different strategy that I like to use that's a little different to buying calls. Okay. So many beginners lose money because this is the easiest way to get into options. But a lot of people don't understand time decay. They don't understand extrinsic value. They don't understand intrinsic value. Data. There's a lot happening right here with this contract and how these things move. And these numbers change every day. As we get closer to expiry date, your theta would then start going up. So there's a lot of things at play. That's why a lot of people think lose money whenever they're buying calls, because there's a lot of stuff that they don't understand and kind of out of their control. That's why I want to introduce to you guys to cash secure puts and covered calls. So I'm in the other side of the coin. I'm selling these contracts to people because I feel like a lot of people don't know what they're doing, and I like to collect premiums. So I'm in the other side. Essentially, we did the exercise with the $236. I would then profit that $236 to me, and I would put up as collateral however much the underlying is times 100. So in this case, I would put up 19.7K to buy right to open the contract and then sell it. And that would get the premium. So we have a little exercise here at the bottom. You sell a put on AMD for a $100 strike, expiring in 2 weeks. The premium is $2. So I get to collect $2, $200 times 100 for myself, regardless of what happens. Okay. And you must have $10,000 in cash in case AMD falls under your $100 strike. So that's kind of like what's keeping you, I think, what kept me for a long time by playing cash secure puts, because you got to have a little bit of capital to put up. So the stock stays above 100. You keep the $200. Your contract that you sold then goes worthless into the void. You keep your money. You're happy. If the stock drops below 100, you then have to buy 100 shares of the underlying at whatever strike that you had set. So in this case, $100. And this is a good thing because I think AMD is a great company. Google's a great company. If I were to sell the contract on Google tomorrow to expire next Friday, and I pocket $160, and the stock drops another, let's say 3%, cool. I'm buying Google at a great price and I'm happy. And then I can, in the other hand, if I didn't get assigned, I would just then sell covered calls. This is the other case where you get assigned. Let's say AMD is trading under 100. You get assigned your contract to buy 100 shares. You then own all of those shares and you sell those calls against it. So you're essentially selling a covered call. You have those shares and you put as collateral to open that call. Okay. So it's, I mean, passive income is a big word. I don't think it's passive income because there's position sizing, there's, stop losses. You can just set it and forget it because you do have your 100 shares in the line. So let's say you own 100 shares of Apple or AMD, whatever. This is Apple, an example. You would then go and sell a $190 call a month out. You get $3 as your premium. I'm selling that contract that we just studied earlier. So every day that goes by, the contract I sold is losing money. Okay, if the underlying stays at the same or higher. So this is basically data. This is theta gain, we like to call it. So this is how you play theta, because I think time decay is one of the strongest things in options. And you saw it earlier. Extrinsic value is a big part of how you value a contract. So I'm essentially playing volatility and time decay. So this example, Apple stays over $109. You keep your shares plus that $300 premium that we had. Apple goes above 190. This is the downside. You then sell your shares at 190, and then you keep that $300 that we talked about. That's the downside. If Apple just rallies to 210, you're kind of in the shit, because you sold a contract saying that you're going to sell your shares at whatever time for $190. So you kind of left on the table $2,000 essentially. So that's kind of the downside, but you can always roll further out and for a strike that is higher. We won't get into that. Like I said, this is kind of, it's a lot, but these are leaps. Love leaps. So this essentially calls, but you're buying them way far in time. So 1 to 3 years out, and very, very deep in the money. Why are we doing this? Because you can synthetically own almost 100 shares of the underlying. I have an example here of a leap of NVIDIA. So this is the stock of the moment. I'm sure you guys have seen NVIDIA. This is how leap structure. You remember we talked about delta, we talked about theta. See how low theta is. It's minimal. It's nothing. That's why this is good, because as every day goes by, my contract stays the same. And since we have so much intrinsic value, because NVIDIA, this contract trades, so this is essentially saying that I can sell NVIDIA, or I can buy 100 shares of NVIDIA at $40 whenever this comes around. Where is the expiry? It's years out. Okay, I don't know. I don't know where I took a screenshot, but right here. So it expires on the 2027 in June 17th, 2027. So this is the right for me to buy NVIDIA at $40 come this time. Okay. And as you can see here, Delta. Remember we talked about Delta earlier? We said every dollar that the stock goes up, my contract then goes up accordingly to however much delta that the contract has. So this contract has a 0.98 delta, essentially 98. So if NVIDIA goes up $1, my contract goes up 98 cents. So almost $1. So this is a great way of you essentially buying 98 shares for the price of a fraction, because this was the cost whenever I added to my watch list, and I may or may not have bought this contract, but this is what you had to put up to buy this contract, a little under $7,000 when NVIDIA was trading at 109. If we do the math, 100 shares of NVIDIA, that's $10,000 and almost $11,000. I can buy this contract for right under $7,000 and have control of 98 shares. And time decay is minimal. So these are leaps. This is so strong. And I feel like a lot of people don't trade it, but these are essentially deep in the money calls where you get a lot of leverage. And look at this, guys. I added this to the watch list on a couple months ago on the 4/23 when it was March. Just in a couple of months, guys, this contract has almost doubled. And yeah, NVIDIA has done this and that, blah, blah, blah. But like you see, you can either buy 100 shares of NVIDIA. If you're already super bullish, you're like, I want to buy NVIDIA. You have 10K you want to spend. You're like, let's buy shares. Don't buy shares. Go buy a leap on NVIDIA. Okay. So you can have less capital that you put up, and you have almost the same leverage as you do whenever you buy 100 shares. So hopefully this makes sense. Leaps are awesome. Here, I read this book earlier. this year. Intrinsic by Mike Ewan. He used to work at Qualcomm or Broadcom, one of the two, tech company, and he was making good money, but he bought a bunch of leaps and retired early and made a bunch of money by using a lot of leverage in a bull market, which we have been in the last 30 years, especially in tech stocks. This is not financial advice. I don't know if we're going to be in a rally for the next 30 years again, but as of this year, we are. So go buy yourself some leaps because I think they're a very efficient financial instrument, especially if you're trying to get into shares and you don't want to play into options with the whole time decay and losing money whenever your contract expires worthless. If you want to be a little bit safer and you're still bullish on the underlying, I think leaps are a great way of doing things because your delta, which is essentially how many shares you control, are still pretty high with a little bit less money. So a little bit longer of a video, but hopefully I can kind of spark interest on options to you guys. And I wanted to share with you guys some different methods that I use. So cash secure puts and leaps mainly. Oh, forgot to show this. So I'm doing the 0 to 10K challenge. This is 2 contracts that I sold on AMD. And we just kind of went over the exercise there. But I made $81 in 21, essentially $102 last week for selling these 2 contracts and putting as collateral this amount of money. And yeah, they're expired worthless. I kept my premium. I got my collateral back. That's how things work. So this is an overview of options. I know I just kind of blazed through a bunch of stuff, guys. Maybe I'll do a longer video on options if there's an appetite for it in the channel. But there's a ton of content on YouTube. I basically learned all of this from YouTube, so you can as well. I will leave in the comments below or in the description a channel called In the Money. So Adam's the one who runs that channel. He's great. I never met him personally, but he's a really smart guy, and he's the one who taught me how to do all of this through YouTube videos. So if you want to do it, go watch his channel. Hopefully I got sparked some interest into this. I am certainly not an expert. I am not a financial advisor. This is not financial advice. This is just a few ways I found to make a little bit of cash and build a better life for myself. So thank you for tuning in. Hopefully you guys enjoyed. Be coming out with more videos on this and the challenge and many other things. So appreciate you tuning in. Leave a like, subscribe, and turn on the post notifications. See you soon.